Joining us now, Bryan Hirsch, an independent financial advisor. Bryan, thanks very much for your time.
Thank you.
Post-budget, I want to throw forward to the discussion on preference shares and what changes we need to look to in the preference share arena.
Well, it's quite a shock, and when you talk about preference shares from a financial planning point of view, it's part of a portfolio to provide income. Nothing more than that. One's not looking for a preference share to create growth. One wants stability in the portfolio. Terrible shock. I mean, 15% dividends tax. We don't know exactly if all the preference shares are going to actually give the higher figure, and they're certainly not going to give 15%. I mean, they were talking when the first announcement came 2 years ago of giving 10%. So that does affect income slightly. I looked at it, it's around about 6.25%. So within a portfolio, depending whether the client's looking for income or growth, you may use preference shares, or you may actually decide now, I'm not going to use preference shares anymore. After tax, I'm going to use property funds, which, at 7.5% to 8% after tax is going to give you around about 5.25%, with an opportunity for upside growth. So I'm not as keen on preference shares. When I'm looking at preference shares for long-term planning, I'm now maybe switching my focus and saying that's not the place to be.
And that's a direct consequence of the budget.
Well, not only the budget, if you look at what's happened, with percentage of prime stayed pretty flat now for the last 18 months. I hear your predictions for end of the year 2012, 2013. I think differently. I don't think we're going to see interest rate hikes for a long time. And I think you've got to get some growth in your portfolio. Just remember one thing. We talk about inflation being 6%. That's not pension inflation. That's not consumer inflation. If you take into account electricity rates and taxes, medical aid, food and transport, you're talking 10, 11%, maybe even more.
We always discuss post-budget the impact that the budget has had on the retirement industry. And were you excited about anything in this budget, or do you feel there wasn't enough to really help out in the retirement industry?
Let me just say, I'm a patriotic South African. From a macro point of view, I thought it was a great budget. I thought it was a terrible budget for our net worth individual. I really do. I think the increase in capital gains worried me, because now we've set into motion the possibility of capital gains going up in the years to come. The exact same thing with dividends tax. So I think that we're going to be, the high net worth individuals are going to be affected. What was fantastic in the budget is, if you're in a retirement fund, any formal retirement fund you're in now is receiving its dividends tax-free. It's not paying capital gains. Any interest it earns is tax-free. It's not part of your estate. I think now people can use a retirement annuity far more effectively for long-term planning. And it's essential, over and above a pension fund, that one uses a retirement plan to add to your future retirement income. Whether you retire or not, it's all about having some financial independence. So I liked what's going on in the retirement annuity industry, but I didn't like too much else in the budget. I don't like what's potentially going to happen maybe next year with interest rates, because at the moment we get the abatement of 33,000 if you're over 65, 22,800. They're going to tamper with that. They're going to tamper with people over the 65, their medical deductions complete. They're going to move it to credits. So I wasn't mad about for the high net worth individual. It's much more difficult now, with lower rates of return, to plan effectively for the long term.
Just staying on the RAs, will the RAs, has it been clearly made that the RAs are going to get those pension benefits? Because reading through the budget, it was only the pension funds that were spoken about, and it hasn't explicitly been made clear that RAs will benefit from that as well.
Look, I see all retirement funds, the act is clear. They've dealt with Regulation 28, how you invest your money. So retirement funds haven't paid capital gains tax. They're not paying tax on the interest. The offshore, by the way, what did excite me is offshore dividends. I mean, last year up to this year, we're paying 40% tax because it's treated as income. So high net worth individuals will pay tax on interest and dividends. But from next year, interest will be taxed. You get a smaller rebate, but dividends are only going to be taxed at 15%. Amazing concession.
That's a great concession.
Fantastic.
Just to see where Treasury wants you to park your money in terms of the carrot and the stick, you would say pushing more into long-term saving vehicles such as pension and RAs, and then also perhaps looking to move offshore. Is that right?
Well, I think within a portfolio, you must understand you have to beat inflation. As I said, you're not going to beat inflation in any money market instrument, including preference shares. And I think the problem with investors, they keep looking back. What did I have? What have I got now? And the minute they start to see the value of their portfolios drop, they panic and move out of equities. But if you've got a long-term strategy and you plan your strategy and you understand there are going to be along the way potholes, and there are going to be these, like we had the last few days, a down. You've got to expect that. But if you look into the long term, you have to be growth orientated. And your growth orientation is going to come from investments both locally in good stocks and offshore. You're not going to get good returns at all from any real interest bearing, whether it's bonds or not, particularly when you're in when you're paying a lot of tax.
How are you feeling about the South African equity environment at the moment? Obviously, there was a bit of an enthusiastic throw forward in what you've just said. You deem it the place to be?
Well, you know, I don't want to say I told you so because I could be wrong. Anyone could be wrong tomorrow. But I've been very positive the last 18 months. I've said, you know, forget about what's happening. Forget about all the noises. You have to look at your strategy. And if you're looking at a long-term strategy, you had to be in equity. There was far too much in money markets. I don't know what people are now doing. They're in money markets. They now are faced with markets having had a good run, particularly over the last 6 months and even going back to 2008. They now are deciding, well, what do I do? Because the exact same thing is going to happen. The chances are they went going into markets as they did in the last month or so, and they found now they're losing money again. So are they going to start to panic? I'm positive. You're seeing the results coming through every single day. You're seeing good corporate earnings coming through. You see those earnings coming through, higher dividend payments. And you compare those type of returns to the after-tax return that you'll get in any interest-bearing stock. There's not much in it. So yes, you've got to take that risk, but if you don't take risk, you can't expect to achieve any growth, and you're not going to beat inflation.
And the other thing is you've got to give it time. Taking a lot of people make a long-term decision and then act in the short term, but you've got to give this time to actually help it work through.
When the markets are rising, everyone's got a long-term view. The market starts to crash. Everyone's got, that long-term view thrown out the window. Yes, come and, you can do a risk profile on a client. Forget all the 20 questions. Just ask the client one thing. How do you feel about losing 20% over the next month? And they'll tell you quickly, I don't want to lose 20%. But if they don't take that risk and they don't understand that over the next 10 years you've got to be growth orientated, you are going to lose out. You can't beat inflation.
You've obviously worked with many clients over the years. Have you managed to get them to buy into your psyche? Have you managed them so that when you see that 20% fall in your portfolio, they sit tight?
I have a lot of clients. I look after a lot of money. And when the markets dropped in August last year, I phoned every client and said, look, sit tight. Don't worry about it. You've got to sit tight. Forget about it. Just put your head in the sand. I only had 2 clients who panicked. And I reassessed last month what happens if they hadn't have panicked and where their portfolios would have been. I don't need to tell you, their portfolios would have been up.
Did you send them those emails, Bryan?
I haven't done that yet. I want to go back to them and say, look, I think you should come back into the market. However, let me say this to you. When someone says to me, I'm scared, I want to get out of the market, I don't try and talk them out of it because I know that possibly the following month I'm going to be wrong because they're going to look at the value and say, well, last month you told me to stay in, my portfolio's down a little bit now. No. Those that panic, I only had a few clients, and hopefully those clients realize now that going back into money market is not the answer. Now they're going to be looking again, where am I going to invest? So they're going back into the market at higher levels. You've got to stay invested.
Kevin, you would pretty much agree with this philosophy.
Yeah, absolutely. As an investor, you've got to try and work out what you're wanting to achieve and how you're going to get there. But then you need to go through scenarios of what happens if the market crashes 20% and how am I going to react, and almost teach yourself to react before it happens, because setbacks are going to occur, especially investing in equities.
I want your thoughts on the cycle at the moment. And as you've said and stipulated, look through the noise, don't focus on short-termism, but what do you think is going to unfold with all the uncertainty that we're seeing globally, or do you think that we are out of the woods?
Well, look, I don't think we're out of the woods. There are going to be a lot of bumps. We are going to hear about defaults, and we're going to hear about things that are going to scare the market, and the markets are going to come off. But you've got to stay invested. Understand your time horizon. I mean, there's a big difference between money that's earmarked for the next year or two compared to 3 to 5 years and then maybe 5 years and onwards. If you've got a short-term time horizon, you have to stay in cash. You can't take a chance. If you've got, that you've got expenses coming up, you may want to put a deposit on a home, a house, you've got things that are happening, you've got to stay in money market. When you start moving to 3 to 5 years, you've got to be a little bit more balanced. You can't be everything in equity. So you've got to have a balanced portfolio. You probably will have some preference shares to give you. It also depends whether you need income or growth. And once you go 5 years onwards, you've got to be growth orientated. What are things going to unfold? I think globally things are looking a lot better. I mean, Europe
US is certainly looking a lot better.
And the fact that they announced that the forecasts for China are going to be lower doesn't mean they're going to be lower. And I think that if you compare what returns you can get in any other investment, even compared to dividend income that you're receiving in other markets, you're doing better. You're getting no interest in pound sterling or euro, nothing. And you're getting maybe 2 to 2.5%, and you can even get higher in good quality stocks. Stocks that you know, stocks like, and I'm not tipping stocks, but stocks like with names like Apple, Cadbury's, Nestle's, Louis Vuitton, stocks that are brands, Swatch, just companies that are brands. A lot of people say, well, I've never heard of that stock. I mean, I think of a stock that we like very much, just again, Yum Brands. People don't know what Yum Brands do. Kentucky Fried Chicken. We know about it, McDonald's. So what I'm trying to say, I think you can get better returns from those stocks with longer growth prospects than you can sitting in money market. And you need it in a growth portfolio.
Bryan, thanks so much for joining us this evening.
Thank you very much.
Thank you so much, Kevin.
Thank you.
That was independent financial advisor Bryan Hirsch on the desk with us this evening.